So today I've whipped out the whiteboard because we're gonna do debt to income. Now this is a video I did probably 2 years ago without a whiteboard, and I used the number 10,000 because it was easy math, right? It's easy to figure out the percentage of a number like 10,000. What's 20% of 10,000? 2 grand, easy. Okay, well, yeah, so a lot of my followers on YouTube were not fans of that video because their feeling was I was being elitist, which is never what I want to do. Like, I work with everyone. I'm licensed in 35 states. I do not discriminate. I don't care how much you make. I want you to succeed. So we're going to do another debt to income video with different incomes so you can calculate it yourself. Now, why do you even care about your debt to income? Well, your debt to income is the biggest indicator on how successful you're going to be with your mortgage. It also indicates what your lifestyle is going to be like. So I've done videos in the past about max qualifying, and what that is when a lender pushes what you qualify up to the max. Easy, right? Well, it happens a lot, and the problem is twofold. Number one, it sets you up in a position to fail. I mean, let me be blunt. The stuff that we can approve you for, you don't want half the time. The other reason is that when guidelines start to tighten up, which we're seeing right now with COVID-19, that loan doesn't exist. That max qualification that lender gave you 2 months ago, it's gone. So I'm going to teach you how to do your debt to income. I'm going to tell you what I look for. Now, keep in mind, this isn't me underwriting your file right now or anything like that. That's my disclaimer. This is just easy math for you. If you're budgeting, if you're planning to buy a house, it's important that you know your debt to income. Now, if you ask your lender, they will tell you. If they won't tell you your debt to income, that's super weird. Like, I would run from that lender because why won't they tell you? It's not hard. Okay, here we go. So, and I apologize for the light rain. I don't know how to light, and this room's a cave. So, debt to income. There's 2 big things to think about. Front end, your front end ratio, and your back end. Okay? I'm sorry if you can't read my handwriting. It is what it is. Okay, so whenever we're calculating your debt to income, we're going to use your gross income. So let's say that your gross monthly income, pre-tax, gross is pre-tax, is $3,000 a month. Okay? So I'm just going to put 3,000 income right there. This is a very important number for calculating debt to income. Now, if all of a sudden, let's say last year you didn't do any overtime, but this year you're doing so much overtime, don't use that because we're going to do a 2-year average of overtime. Be conservative with your numbers. And if you didn't get overtime last year, but you're getting a lot right now, are you going to get it next year? I wouldn't want to bank my whole house on overtime being consistent forever unless you have a 2-year history of it being consistent, which at that point you wouldn't. Okay. So $3,000 income, let's say that you want to buy a house and the monthly payment, principal, interest, taxes, and insurance is $900 a month. So we're just going to do 900 right here for PITI. So principal, interest, taxes, and insurance. You might see lenders reference PITI quite a bit. Now, on top of that, let's say that you also have some credit card payments and the minimum monthly payments on those are $200. And let's also say you have a car payment. Who doesn't? So let's do $150 for the car. Okay. Now, to figure out your front end ratio, you're going to do the PITI divided by the gross income. So we're going to do 900 divided by 3,000. So that gives us 0.3, which is a 30% debt to income for your front end ratio. Now we're going to do the 900 plus the credit cards plus the car. So 900 plus 200 plus 150, and that's going to be 1,250. And we're going to do that divided by 3,000. And that gives us 42%. Okay? These are good numbers. So, you know, you're more financially conservative people like Dave Ramsey, for instance, who I love. He's going to say to keep this number under 20%. Realistically, he doesn't want you to have a mortgage, but if you have to have a mortgage, keep this as low as possible, which I don't disagree with. However, there's so many areas where it's not feasible. California is one of those areas where it's really difficult to find a house where anyone is under 30%. So I would say if you can stay under 30%, awesome. realistically, as a lender, I can approve you up to 43% on the front end. But remember, this is pre-tax income, so it's not something I would wholeheartedly advise. Now, the back end, when we computed it, came in at 42%. 42% is close to the max of where I'm advising right now. So I'm telling clients, let's try to stick under 43. There are programs that will take you up to 50. There's programs that will take you up to 55. But what we're seeing with COVID is we're seeing a lot of those programs go away. So going back to the more conservative matrix of 43% is going to be how the loan approval you get done now is still valid in a month. And also, you know, doing 50% of your gross income just between what's on your credit report and your housing payment, it doesn't leave a lot of money for gas, cable, telephone, food. It doesn't leave a lot of money. So you really want to make sure that you understand these numbers. Now, if a lender said, you know, your back end is 67%, they shouldn't be approving you. And if they are, I'd be wondering what type of loan. There are some loans that do not have debt to income requirements. VA is actually one of them. If you can get the computer to approve it, you can move forward. It doesn't mean it's a good idea, guys. So you really want to make sure that you have power and you have control over your numbers. And if your lender won't tell you, once, you know, I've already said this, dump them. But if you don't want to dump them, this is how you do it yourself. So the stuff that goes into the back end is the principal, interest, taxes, and insurance, and everything on your credit report, the minimum monthly payment. So student loans, car payments, credit cards. This does not take into account utility bills. This does not take into account child care, unless it's VA. This does not take into account a whole host of everyday expenses that you have. So you're going to want to be very aware of this number, and I would strongly advise you not to max qualify because there's so many things that this number does not take into consideration. So now I'm going to do a couple really quick ones with you just to show you stuff that I see a lot that is a problem. And I've actually gotten into conversations with borrowers where they're really mad at me. And the reason they're mad at me is because I'm like, your debt to income's too high. Okay, so let's do some math. Let's say you make $5,000 a month, okay? And you want a house that's $2,500 and you just got a beautiful car, which is $900 a month, and you have $700 a month in credit card debt because you love to shop. Me too. Okay, let's do our numbers. So get your calculators out and let's see if you can figure out this debt to income and why I'm going to say no. So first we're going to do the principal, interest, taxes, and insurance versus the gross income. So we're going to, I don't even need the calculator. That is 50% on the front end. 50%. So 50% of their gross income would be going towards housing. 50%. Pre-tax. Okay, and then we're going to add these other numbers, the car payment, that glorious car payment. And car payments to me are one of the things where I just go, you've got to be kidding me, because I see so many credit reports where someone makes $3,000 a month and their car payment's $1,000, and I'm like, what are you doing? And they're like, well, the car guy said it was okay. Of course the car guy said it's okay. He's selling you a car. You can't live in it, guys. So your car payment should not be 30% of your, debt to income. Feel free to use this when you're calculating car payment too. Okay, so I digress. 2,500 plus 900 plus 700 is 4,100. So 4,100 divided by 5,000 is 82%. Okay. It's cool that you're making $5,000 a month. That's awesome. However, you're spending way more than you make. An 82% back end is a recipe for failure. You will not be able to survive with an 82% back end because the thing is once again, this is pre-tax. It's before Uncle Sam takes what he needs. It's before Social Security. It's before Medicare. It's before those 19 things on your paycheck. So if you're at 82, right, before that, how is this going to work? Because once they take everything, you're probably at 80. Recipe for failure. Recipe for failure. Okay, now you're probably wondering, how do you calculate mortgage payments? So if you want help calculating mortgage payments, send me a text message, 707-478-0637. I have an app through Guaranteed Rate, the company I work for, where it will pull fresh rates for you guys so you can see what rates are doing every day, and it calculates the monthly payment for you. So you could be like, okay, you know, $100,000 house, 5% down, what's the payment? $200,000 house, 10% down, 20% down. You can go crazy with this app. It doesn't cost any money. We don't stalk you via it. It's literally just a tool for buyers to have so that you guys can do some planning and be in control. It's important to be in control. This is the biggest purchase you're probably ever going to make. You need to go in eyes wide open. So if you want me to text you that app, shoot me a text to 707-478-0637. As I say in every video, I'm licensed in over 35 states. I do mortgages, purchases, and refinances. Call me. You will be talking to me, and check out you guys got to do this. Check out your debt to income. Know these ratios so that when you do talk to a lender, you know what you're getting into. Thanks for watching.